Hi, I'm Justin Hales, the founder and president of Green Rock Consulting. In this video, you will learn how to increase the rate of return on all the real estate investing you do by becoming your own banker and financing your investments through our velocity banking concept. If you'd like to schedule a discovery meeting to learn more about how to apply this to your life, fill out the information below or email us at hello@greenrockconsulting.com. We look forward to speaking with you.
So let's take a look at an example of how you can improve the rate of return on your real estate investment by utilizing the velocity banking concept. Now, this is actually a real life scenario that we dealt with. In this particular scenario, the person owned the property and was trying to decide whether they wanted to sell it or keep it, and if they kept it, how to make it more profitable. But we can do this with someone who, if you're deciding whether to make an investment or not, or you've decided to make an investment in real estate and you're trying to decide what's the most profitable way to fund it, we can do that a variety of different ways. And this is a really great tool. It's a Truth Concepts tool. It's just a software program that anyone can buy, and we find it just really useful for our clients, particularly our real estate investing clients. So let's start with this example. Now, this particular property we figured was worth $175,000, and so we'll also enter the price to be $175,000. Now, that's not always the same, and that's why you can enter those things differently. There were $5,000 in closing costs in this case, and we'll just assume no realtor fees for a total price of $180,000. Now, the value of the land in this case was assessed at $25,200. And why does that matter? Well, it matters for tax purposes because you can only depreciate the value of the structures. So the value of the structures there pre-populates $149,800. Now the bank, the most that they would do in this case is 70% down. It was a multi-unit, so the most of the loan we could get was $122,500, and the rate of return was 5% for 360 months. So you can see it automatically populates the loan payment there, which also transfers up to the monthly expenses. And for now, we're going to assume no second mortgage. So moving over to the monthly expense column, we have the mortgage payments already in there. In this particular case, there were property taxes of $264 a month. There was insurance at $110 a month. There was maintenance at $51 a month. And there were a couple of other expenses as well. They had property manager, so that was costing them $170 a month. And there were utilities that it was a multi-unit, and there were some utilities that the owner was paying, so that's $488 a month. And that is the total of the monthly expenses. In this particular case, the total monthly rent was $2,435. Their income tax bracket was 30%, the capital gains bracket was 15%, and the depreciation recap tax bracket currently at 25%. Now, moving over to the third column, we need to make some assumptions about how long we want to analyze this. So we just chose to look at it over 10 years and assess it over 10 years. So that's 120 months. We can also include a property appreciation rate in here. I tend to not do that at first, and we really want to look at the rate of return assuming no appreciation. And we can always go back and add that in, an appreciation rate the client feels is reasonable, just to really look at it. But for now, we'll just leave that blank and we'll just analyze the cash flow alone. So you can see that pre-populates some things. There's the down payment amount and the net incomes, the interest payments, the interest deductions. We're going to depreciate this thing over 27.5 years. And there's the monthly cash flow, $565. The future value of the property is $175,000. That makes sense because we haven't appreciated it at all. It's worth what it was. After 120 months, the loan balance is down to just under $100,000. And when we go to sell this thing, we're going to have some costs. Let's assume 8%. There's some depreciation recap tax, no capital gains tax. Again, that makes sense because we chose to assume it didn't appreciate. So then the net cash out's $47,738. So we want to look, this annual rate of return comes out to just over 11%. And that comes from $57,000 down, that's the amount invested. Then you've taken out of it $565 a month. And then in the end, after 10 years when you sold, you took out $47,738. And that annual rate of return is 11.02%. So we can check that too. The calculator is really good, but we can just check it with a simple rate calculator and see if we're in the ballpark. Now, this actual rate calculator can't do as well because it's changing every single month. Every monthly loan payment, the interest deduction is falling a little bit, and we can't capture that in a simple rate calculator like this, but we can get very, very close, and sometimes it's important to just validate that the rate of returns are reasonable, and you'll see why soon when we start talking about how we can make the rate of return go up a lot. So in this case, let's switch that to monthly. The monthly payment they're taking out, $565, and then the future value is $47,738, and we're doing this over 120 months. There. So you can see that the annual rate of return here is estimated to be 10.96%. That's as close as we can get in a simple rate calculator. But it shows that we're in the ballpark. Given this assessment, he was looking at a property that was projected to earn or return just over 11% per year to him. Now, how can we make this more profitable by utilizing our Velocity Banking contract? Now, if we assume that he already has a Velocity Banking contract funded, and say there's $50,000 in there available to borrow, what if we were to borrow that money out and utilize that for part of our down payment, so that we in effect could really finance the whole thing, or we could finance most of it? Let's just say we did that. So we took out a second loan. This was a loan against our Velocity Banking policy. The rate, again, is 5%, and we can pay this back on whatever terms we want. We know that from our understanding of Velocity Banking, but we'll just pay it back at the same pace that we're paying back the other loan, 360 months. You can see it pre-populates the loan payment, $268.41, and that automatically gets added to the monthly expenses right at the top. Okay. Now, really nothing else has changed. All the same expenses exist, the same property, the same time frame for analysis, everything else. But what you can see is that the rate of return jumped up to 61.7% per year. And I hear all the time at this point something about how if it sounds too good to be true, it probably is. And I used to say that a lot, and I just don't like that saying anymore. Because this is exactly how it works. So let's take a look at why, though. Take a look at why. The difference here is that the down payment is significantly lower, which means you only put $7,500 of your own money into this situation. The rest of the money was other people's money. We used the bank's money here for $122,500 of it, and then we used $50,000 of the insurance company's money when we borrowed against our Velocity Banking contract. So you really only took $7,500 out of pocket, and that's the cause of this significantly higher rate of return. So if you put in $7,500, and in exchange for that you collected $354 a month, and then in the end you cashed out a little over $7,000, the rate of return is 61.7% per year over 10 years. And we can check this again with our basic rate calculator. Again, we can't get it right on, but we can get really close. So let's check this out. So in this case, you can see the other calculator, the rate of return. So the difference here is we put a lot less money into the deal. Now we can see that our monthly, the amount we get to take out monthly is less. It's $354, not $565, and that's because we had this extra loan payment to make. And then the future value, in this case, you got $47,000 out. In this case, we're only getting $7,067 out. That's a lot less. And forgot to switch that to monthly. And we do that over the same time frame. Yeah, and the rate of return is 59.43%. Again, that's as close as we can get with a basic calculator, but it's right there in the ballpark with the 61.7. So the biggest difference here is that you put very little money down, and that causes the rate of return to skyrocket. Now, if you could buy each and make all of your real estate investments with that little bit of money down, it would cause the rate of return on all of them to skyrocket like this. And if you only had to put a little bit down, then I guess the question is, how many more could you buy and how much more profitable would it be? This is extremely powerful. If you have some questions about how to apply this to your own situation, or if you're looking at a particular property, we'd love to have a discovery call with you. So fill out the information on the screen below or send us an email, hello@greenrockconsulting.com. Again, my name is Justin Hales. I'm the founder and president of Green Rock Consulting, and we look forward to speaking with you.